So good afternoon, everybody. Thank you very much for dialing in. My name is Atul Shinghal. I am the founder and CEO of Scripbox. My co-host today is Sanjiv Singhal. We are not related in any way. We are like the Thompson twins, one without the H. He's a co-founder along with me and runs everything at Scriptbox. The idea today is to answer some questions and give you our view of what's happened in the last 24 hours and what we can expect. It is still an emerging scenario, but we thought it appropriate to get information out to you as soon as possible. There is a chat window available to you at the bottom to ask any questions or in the Q&A. We'll try our best to answer all of them during the course of the presentation. If we can't, be rest assured that the team is recording all the questions you guys are raising, and we'll try our best to get those answers to you as soon as possible. We have a small presentation which we'll talk through over the next sort of 20 minutes. Please keep typing your questions out as we go forward. And once we get to the end, we'll again try our best if you missed out anything. We feel, given the conversation during the course of the day, we've been talking to customers have been calling in, writing in our own house view. We have a certain set of questions we've answered. Yeah, so we're going to talk about the impact of the Franklin Templeton closing of 6 funds, which is a unique, not a unique thing, which is a very rare occurrence in the Indian markets. We'll give you our reading of what the issue is and what could have happened. What is the impact on Scriptbox investors? So we have taken a very our customer-centric view of this. We'll spend some time in sort of explaining what risk in debt funds means. Most people believe debt funds are sort of capital protection and doesn't matter. We'll just take you through a quick sort of a 101 on debt funds and risk. It's not a detailed deep dive. We are happy to spend more time on that, but this is just to explain our thinking behind this. We'll talk about how we at Scriptbox approach debt fund selections and why we don't sell a number of funds or don't offer them at all. And then obviously answer some questions and concerns at the very end. Sanjiv. So I'll talk you through the issue at hand. Sanjiv, next slide. The core issue is that Franklin Templeton, as of last night, stopped all investments and withdrawals into 6 funds. That essentially means anybody who had actual investments in those today cannot take any specific action immediately. Though they can see the NAV, this does not mean that the money has disappeared. It just means that transactions on those particular sets of funds have been halted for some time. Franklin has said that over the next few days they will clarify the exact stand, and they would start redemptions in due course as they see money coming in from or as they're able to liquidate the assets. Remember, this is no distress sale. This is not that the money has gone to zero and they don't have funds. They have assets. They have value to those assets. It's just that given the extraordinary situation of COVID, lockdown, liquidity crunch, their own portfolio being relatively high risk, and we'll talk about risk in a little bit, they saw an extraordinary run on redemptions. And when redemptions happen, at some point in time, they didn't have enough liquid assets for them to, they couldn't actually liquidate the assets which were underlying the fund itself. And hence, they started borrowing, and SEBI had allowed a 20% window against the total fund size as redemptions. They ran out of that borrowing limit also, and hence they decided prudently so, and I think it's the right decision, because otherwise you're left with some really dead securities and a few customers holding it. So I think they've, in their best judgment, done the right thing. So this is a response to multiple things: redemption pressure, liquidity in the market, liquidity in their own portfolios, the risk they were carrying, plus just the extraordinary situation. This does not in any way impact any other Franklin Templeton funds. So if our customers or any other customers are holding Franklin Templeton funds, there's no cause to panic. They're a good fund house. They've been at this for some time. They've got a solid reputation. I'm sure they've taken this decision after a huge amount of prudence and discussion. So this is not a knee-jerk reaction. This is well thought through. It is in the best interest of the customer, of their customers in that portfolio. So the people who invested in those 6 funds cannot do anything at this point in time but watch the space. But there is no need. It's not a distressed sale. That's our view of where we are at that. So what is the impact to Scripbox investors of these 6 funds? Absolutely zero. We do not recommend these funds. So none of our recommended baskets. So as our Scripbox customers would know, we've got a short-term wealth basket and an emergency fund basket, where debt funds typically will appear, and we'll talk about different types of fund types. We have not recommended any of these 6 funds in our recommendation. There might be a couple of customers who have some of these funds, either because they were an ARN transfer to us, or because they were based on the recent merger with Upwardly, and we are taking care of those customers separately. I will not answer that question here. So the key piece is most, if not all, of our customers are not impacted because these funds are not part of our basket. And we'll talk about why not, because the credit risk in that portfolio, some of the category risk we've seen. In addition, it's important to remember that when you select a fund, underlying it has multiple securities and what we call a portfolio. It'll have some government securities, it'll have some AAA paper. And we've made sure in our fund selection that our recommended funds have good portfolios. And what we can comfortably say that it vindicates our approach to fund selection, where we take risk very, very seriously and not only performance. So it would cut a long story short, nothing to worry about for Scripbox investors. This will not and it should not impact you at all. I'll hand over to Sanjiv to talk about a little bit about risk at debt. And we'll come back to specific chat questions about how it matters.
Yeah, so understanding the element of risk is, I think, very important for this discussion, for people to make an informed decision, not just at this event, but going forward as well, because this is not the only thing that you're going to do in your life while investing, and many years ahead. And some of these principles are important to understand. Right? So as most of you might actually already know, there are 2 primary risks in debt fund investing, right? So which are usually linked to the kind of return that you're expecting, right? So you take a little higher risk and you get a little higher return. It doesn't always play out like that, because sometimes you end up taking higher risk and end up getting low return. But that's what we call an element of chance within investing. Right? What has happened in this specific case is that historically, some of these funds have actually been able to provide returns that are superior to market. And they were able to provide that superior return because they were taking some additional risk. A good example of this is, a category called credit risk fund, where the fund manager takes that extra element of risk to deliver the return. Most fund managers manage it well, but as a strategy, it tends to work out in good markets, and the last 18 months have not been great. So we've seen some of that impact the funds that have historically given a slightly better return, right? So the risk is the spread of the probability at a certain spectrum, at a certain so in portfolio theory we call it portfolio frontier. Within that, you will actually see within a category one fund delivering a slightly superior return and the other fund delivering slightly inferior return, and that's the risk that spread that happens. So it's kind of plotted here. But overall, within categories, you will see So two types of risk: interest rate risk and credit risk. So we've just plotted the various debt fund categories here to show you that as all debt funds are not the same. Typically, uh, funds that invest in low maturity investments, that is investments that are maturing in 30, 60, 90 days, tend to have less sensitivity to interest rate movements. And funds that invest in longer term securities, so for example, gilt funds, which invest in 10-year duration paper, will typically have higher sensitivity to interest rates. This specific instance that we are discussing today is actually not about interest rate, not about credit risk. And we have internally, as a part of our selection process, we score each fund or the portfolio of each fund on the credit risk that they're taking, right? These are category averages. These are not fund specific. So even within a category, depending on the type of paper they invest in, you can actually see that certain funds typically tend to have lower credit risk and some funds tend to have higher credit risk. There are three categories of funds that are in orange, which is ultra short, low duration, and liquid. These are the three categories that we recommend for our investors because they have both low interest rate risk and low credit risk.
So this is actually an inverted graph. This talks about credit quality. So as you go right on the graph, you see higher quality. So this is the quality of the graph, the quality of the risk which we're talking about in this graph. It's indexed. It's proprietary to us, and hence the numbers are not visible to everybody. Yeah.
So what do we do at Scripbox, right? So when we recommend debt funds, our focus is safety, because we believe that anybody who's chasing return is actually more likely to be investing in equity. Right? Within debt funds, we believe marginal extra return is not worth it, right? One of the reasons we don't, we only invest, we only recommend ultra short, liquid, and low duration funds, right? And we have three types of risk: liquidity risk, interest rate risk, and credit risk while we are recommending funds. So we apply these three filters. Size. So fund has to be of a certain size to even qualify for selection for Scripbox. Because a smaller fund, as we've seen in the recent past, starts to face liquidity pressures if redemption build up. The category of fund, and the two previous graphs kind of relate to it. There are certain categories that provide a good balance of interest rate risk and credit risk. And finally, we get to specific portfolio of a fund, and we score it, and we look at the trend of it over a period of time, not just at a point in time. Because a point in time, the portfolio could be great, but over the past 2 years, 3 years, we see how the fund manager has actually been allocating money, and we look at a score based on that. Only then do we look at the consistency of return, right? So, and that makes sure that risks are managed and you get a reasonable return for your investment.
Right. So that gives you a good sense of, I hope, of how we look at risk and why Scripbox's way we are very proud of. This is a great time for us to be, as founders and as part of the Scripbox family, feel extremely vindicated. We do get asked the question of returns very often as to why we recommend what we recommend. There's a lot of sort of expertise gone behind it. And we are proud to say that it's moments like this which tell us that we're doing the right thing by Scripbox. So this is not a sales pitch on Scripbox. It's just a vindication that a credit weighted way of approaching debt funds, especially, and all funds, is really important. I'll come back and answer a few questions. There's a chat window which is open. We're getting questions on that. There are two specific questions being asked around the Franklin funds which are in our portfolio. One is a Franklin Feeder US Opportunities Fund, which actually we believe, because it is linked to the US markets, is absolutely safe at this point in time. I mean, it will do what it's expected to do. So there is no need to withdraw from that. There is a linked Franklin Savings Fund, which if you're doing a systematic transfer plan, it allows you to link that. That's also a highly rated fund. We've done the underlying analysis and we feel comfortable that the underlying securities are safe. So we'd continue to recommend keeping the money there. I hope that answers that question. There is a question around categories. So what are ultra short-term funds and is that safe? Given that they're one of the funds from the Franklin family which got closed of the 6 funds was ultra short-term fund. We still believe that a combination of credit risk and liquidity risk and the interest rate risk in the ultra short-term funds, if the portfolio is prudently chosen, is the right thing to do. We've looked at our underlying of the funds we recommend at this point in time, and we continue to recommend them. So we feel it's the right thing to do. So that's where there's been a general question about, should I exit all my debt funds? What should I do with my debt portfolio? We still always maintain that if you're in the right funds and you put the money there for the right reasons in terms of your asset allocation, we would not panic. We would recommend that. So can you kindly continue investing in those funds? Obviously, review your own portfolios and your own asset allocation. For the Scripbox customers specifically, we recommend remaining invested in the portfolios you are. Do a review with us regularly. If you have any specific concerns and if you've got portfolios outside Scripbox, please do write to us at help@scripbox.com. We have a capability of scoring every fund on our proprietary tools, which we look at multiple facets. And to the best of our ability, we'll come back to you and tell you what we think you should do. So broadly, we feel remain invested in the portfolios recommended by us. If you need to know more, write to us at help@scripbox.com. And we'll come back to you. Send us a more detailed version of your portfolio. We'll do an analysis. And now there are a couple of questions and which we'll try to answer, which are around the question of, hey, I'm actually in these 6 funds. What do we do? We really don't have an answer. The answer is that we'll have to depend on Franklin Templeton to release that money over time. It will not happen immediately. What's happened, as we've written in one of our blogs, is that their shorter duration securities have actually got liquidated. So what they're sitting on now is slightly longer term securities. And once those do mature and that money does come back in, that will get distributed to the unit holders. Like one of the attendees has asked us that I looked at the underlying portfolio. And this is where I don't want to sound arrogant, but this is our job. We've got credit scoring models. We've been doing this for a living. So just trust us to do the right thing in these things. So the question is that, yeah, for people who are invested in those 6 funds, there's not much we can do at this point in time. We would recommend just reaching out to Franklin Templeton, watching the news, being in line with them. You can't do anything more than what it'll get heavily regulated, it'll get monitored, and they will do their best. They're not here to sort of cheat you or anything. They're definitely committed to looking after their investors. They want to build a business. Definitely, they've been around for a long time. So my recommendation is that just watch the space. In terms of, though it's not relevant to today's discussion, there's this whole question which is being asked around, is this a good time to enter the markets? And our stand has been that, yes, if you have done your asset allocation right, if your emergency fund has been taken care of, if you've taken care of your debt allocation, then doing a systematic transfer plan through an STP, what we call the smart transfer plan at Scripbox, would be a good idea. There's no guarantee how long it will take for the markets to recover and how choppy they're going to be. But if you believe in the next 5, 7, 10 years of the Indian economy coming strongly back, because good companies are available at a valuation discount, and there will be profit consolidation in the good companies, I believe the good fund managers will be able to buy those companies at a discount and give us some great returns over the next 5, 7 years. So there was a question around STP. So towards that, yes, it's not impractical to invest in the systematic transfer plan and then move money into equities over a certain period of time. In terms of what do we recommend, which funds, that's what you do for a living. Please log on to scriptbox.com, download the app, read our blogs. And we've got a very clear recommended set of funds which we believe people should be investing in. I'll take a couple of more questions. You mentioned that none of the investments made via Scriptbox are at risk. I saw the FT news and set a withdrawal for an emergency fund I have with you. Should I reconsider the decision? Absolutely, you should. If you don't, we are anyway going to get on the phone to call you. We are recommending to all our customers, do not panic. You've put the money there for the right reasons. We've looked at the funds. And at this point in time, our house views very confidently that risk is what we had planned for. So that's where we are. Sanjiv, you want to answer any more questions you want to pick up?
Yeah, I think there was one question about funds in this category. The category similar to what Franklin Templeton has closed, have poor paper, and should we worry about that? And the answer is yes and no. That's actually what we said. Some of these categories are not what we would recommend for consumers, but some of these are something that we recommend. For example, ultra short, right? Within that, each fund has its own attributes and characteristics, and we spend a lot of time, energy, kind of selecting and tracking those funds. We don't sit on, our once after recommending a fund, we don't sit quietly. We track it on a regular basis. Actually, our internal tracking is weekly, where investment committee looks at it and daily because of the data stream. So within the categories are not bad. Funds could be. So rely on, I'm going to make a Scriptbox pitch, just rely on our recommendations.
Right, I'll take the last question. It says, does this mean that the returns will get affected in STP? Is it only a monthly transfer or can one do a daily STP? We believe we've done the math, daily, weekly, monthly. They're very similar. It's not worth all the noise in your portfolios, on your bank accounts, everywhere else to do a daily STP. We believe monthly does equal justice. It's not that the market is running away. So we would recommend going with the systematic transfer plan, put the money in there, put a monthly transfer. It should work because you don't know the day you buy. If you are looking to time the market, which we are completely do not recommend, then doing a one-time investment every time you feel would be more appropriate if that's the appetite you have. But our recommendation is to trust the system, to trust the algorithms in terms of the asset allocation, the fund selection, and the process. There's a question, can you list the 6 funds which are winding up? They're very much in the public domain. I don't have them in front of me handy. Sanjiv, we just
actually, if you just go scriptbox.com/blog, you will find our latest article on this topic, which lists the 6 funds.
Somebody just posted it. Franklin India Low Duration Fund, Franklin India Ultra Short Bond Fund, Franklin India Short Term Income Plan, the Franklin India Risk Fund, Franklin India Dynamic Accrual Fund, and Franklin India Income Opportunities Fund. It's not easy for you to remember this. I think the right answer is just go to the blog. We've listed them down there. It's got all the details as to what the fund size is, etc. You can always drop us an email and we'll be more than happy to answer you. In terms of fixed maturity plans, we are not, we do not recommend them. So we will not be in a position to recommend that. So our algorithms don't suggest those at all. We are nearly at 4:30 now. I think we have tried our best to answer multiple questions. If you feel that you still have some questions, please feel free to write to us at help@scriptbox.com. Read our blogs. Our existing customers should remain assured that you're in safe hands. And thank you very much for trusting us with your money and helping you in wealth accumulation and wealth growth. And this question, the final question and answer, which keep getting asked, can we invest now? Is it good time, sir? yes, it is a good time. Your asset allocation should be taken care of. If you have the appetite for long-term wealth creation, please do participate at this point in time. Good companies are available at discounted valuation to good fund managers, and hence trusting them would be the right thing to do. We do not take a position on what returns can you expect. So we are coming to a close. Thank you very much once again for everybody for dialing in, and thank you for taking the time out. I hope we've been able to answer some of your questions. If not, please do write back to us, and we'll try our best. Thank you very much, Sanjiv, for co-hosting this with me. And we will post a recording of the webinar on our various social media handles. So if there's anything you want to share with your friends or anything from there, please feel free. On that, I'll call the meeting to a close. Thank you, everybody. Have a great weekend. And believe in the process. Believe in the process. That's the way you will have long-term wealth accumulation and long-term wealth creation. Thank you very much, and be safe in these difficult times. I hope we all can get back and into normal time sooner rather than later. So God bless and thank you.